The physical silver market is perhaps the most manipulated market of all time. It is known as the devil's metal, as it is so volatile and rips people's accounts apart. This manipulation is a fact of life, and if you've been involved in the silver market for any amount of time, you have felt what it's like to be on this sickening ride. This manipulation of the silver market is a problem for all short-term paper traders and is a gift of a lifetime to all physical metal stackers. I want to shed some light on this manipulation so that you can use this to your advantage. The first thing that we all need to understand is why it is manipulated. Everything in this world is tied to the dollar: our corporations, our government, our military, our jobs, our food, our way of life. So long as the dollar has the perceived value, that paradigm functions. In order for that very incredibly powerful position to persist, there must not be any weakness in the dollar, which is why you always hear them talking about a strong dollar policy, when in fact a weak dollar policy of printing money is all they do. That is why over this past decade the dollar has lost half of its purchasing power. Our dollar is fiat, and it has nothing backing it except for our faith in it. Our dollar is based on debt. Every dollar that comes into existence has a dollar's worth of debt and interest attached to it. When debt is created, money is created. When debt is paid off, money is destroyed. Our debt-based monetary system must create more debt every year in excess of the debt and interest accrued the year before, or we will suffer the mother of all margin calls. In order for them to continue to provide more debt into the market to keep this game going, they have to contain people's expectations of inflation. They do not really care about inflation per se, only what you think that is happening. That is why they're only concerned about the expectation of inflation. This is done through a myriad of tricks to make inflation seem much lower than it is. They do this so as not to scare you while they gut your savings and earnings. This also ensures that the dollar has the ability to buy real goods and services. So long as they're able to create money out of thin air, and you and everyone else is still willing to accept this money, they will have power. So manipulating commodities is very important to keep this structure going, not only for the purchasing power of the dollar, it also ensures cheap materials for corporations to profit off of, and also keeps third world nations and producers of commodities in debt to the banks. This debt is also useful for manipulating other nations to support our efforts in the UN. Silver is especially important for them to manipulate because not only is it a commodity, it is a natural monetary competitor to the dollar. And it is an incredibly small market that can act as a canary in the coal mine when the dollar dies. So how is silver manipulated? In the past, governments manipulated silver by simply demonetizing it, like the crime of 1873, or fixing the gold to silver ratio, or taking the silver out of our constitutional silver coins in 1965. I have already covered in the Silver Bullet and the Silver Shield the extraordinary efforts they used against the Hunt brothers, and when they twisted Warren Buffett to drop his silver adventure. Modern silver manipulation is different from that of the past. First, people must realize that there are two completely different silver markets. There is a paper electronic market, and there is a real physical market. The paper electronic market controls the price of both markets. The interesting thing about the paper electronic market is that the average time of ownership of these positions is only a few minutes, as they are traded by computer algorithms. This hyperactive trading becomes the market and creates a false impression of real activity. Think of it like the mainstream media reporting about mega millions or celebrity news on a highly frequent and noisy basis. It creates the view that nothing is really going on in the world, when in fact there are very real important things happening below the surface. Well, the paper and electronic silver markets are simply price propaganda to paint a false picture in the market, while the real physical market is only moving powerfully one way. Beyond the high-frequency trading, the criminal elite also use fractional reserve bullion banking, promising the same ounce over and over again to multiple people. So long as no one ever comes to take delivery of the metal, the game will continue. They also lease metals that they don't have, providing liquidity into the market and a false sense of supply in the market. They sell short paper contracts of silver into the market, suppressing the price by falsely selling more metal than they actually have, and then continually rolling over those contracts so they never have to settle. The 8 largest banks are net short 155 days of global silver production, and it has been that way for years. The banks also use the ability to see everybody's positions to sell through people's stop losses. Since these brokers have both access to the buyers and sellers of the markets, they know where everybody's stop losses are. Then they have derivatives on top of everything else to make bets on just the movement of, and that could be thousands of times more than the actual metal that's out there. All of this manipulation will end the moment that they cannot deliver one physical silver ounce that they promise. This is the day that I invest for, and all the rest of it is just noise along the way. Most people remember October of 2008 as the beginning of our current economic demise. The reality is, it started in March with the collapse of Bear Stearns. What most people don't know is that Bear Stearns' collapse was caused by silver. Bear Stearns was the first major bank to fail. They were shorting silver that they did not have. On the same day that they went broke, silver skyrocketed to a multi-decade high of $21 on March 17, 2008. When Bear Stearns went broke, JP Morgan bought Bear and their massive silver short position for $2 a share. That following summer, JP Morgan blew the price of silver down 60% from $21 to $8, a truly gut-wrenching year to be involved in silver. There was no logical reason for the price of silver to go down like that in 2008, and I just kept coming back to the same fundamentals that I've been covering in the Silver Bullet and the Silver Shield, and just kept accumulating silver. I then went on to see silver go up 400% in the years following. Anybody involved in silver at that time had a sense that something was wrong, but we never had any strong facts backing up our suspicions. That is until Andrew Maguire. Andrew Maguire was the first big break that we all had to see behind the closed doors of how silver manipulation worked. Finally, we had an insider that showed how JP Morgan manipulated the silver markets and how insiders reap huge risk-free profits from coordinated attacks on the silver markets during crucial times, like options expiry and Fed statements. Andrew Maguire predicted that a manipulative event in the silver markets and gave detailed information in an email to the CFTC about what to expect, and sending it on February 3, 2010, 2 days prior to the event. The event transpired exactly as Maguire predicted. Even while the event was taking place, Andrew Maguire sent emails in real time pointing out certain details because the CFTC enforcement seemed not to understand how to interpret the data. All that information fell on deaf ears as the CFTC and SEC turned a blind eye to the matter. They did this because they're bought and paid for. The most prominent example is Gary Gensler, who made partner at Goldman Sachs by 30 and then headed off to the CFTC to become the regulator of the markets that his buddies reap billions of dollars of shady profits. These regulators are there for only one reason, to give the illusion of legitimate markets and act as a pressure valve for people to vent their frustration at the rigged markets. Nothing will come from them. Frustrated with the CFTC, Andrew Maguire went public with GATA, the Gold Antitrust Action Committee. After he went public, he and his wife were injured in London in an apparent hit-and-run accident on March 26, 2010, the day after his name came to light during a CFTC hearing on limiting gold and silver positions held by large market participants in order to prevent manipulation. The next big thing that happened in the silver market was August 31, 2010, when JP Morgan closed its proprietary desk on commodities to meet the Volcker Rule. Proprietary desks are when trading occurs for the bank and not the clients. The Volcker Rule is put into place to keep 2008 from happening again by limiting risk taken by lenders. From that day on, silver ripped from $17 to $50 by the end of April 2011. I believe that this marked a new era of price suppression. JP Morgan is just a front for the Anglo-American empire. They act as players and are not power themselves. Even Jamie Dimon, who runs JP Morgan and sits on the New York Federal Reserve Board, is still a paycheck player at the end of the day. But something changed with this Volcker Rule. The problems are now systemic and far too big for JP Morgan to manage on their own. I believe that the Volcker Rule was just window dressing to make it seem like the banks are not the problem, but I think behind the scenes, the Anglo-American empire needed to have the Fed and the Treasury take on the risk to their unlimited balance sheets to manipulate the market. More on this a little bit later. As soon as JP Morgan shut down their proprietary desk, silver broke free and ran from $17 up to $50. Anyone short silver would have to keep putting up a lot of money to keep meeting the margin calls as silver tripled in value. But things started getting out of hand in April as silver closed in on its 1980 nominal high of $50. In April, on average, there was 1.1 billion ounces of paper silver traded every day on all the exchanges, the COMEX, the SLV, the LBMA, the Shanghai Gold Exchange. There is only about 1 billion ounces of silver mined every year, and only about 300 million of that is available for investment. If you break that down, that 300 million works out to about 1 million ounces a day. So if 1 billion ounces of paper silver was traded every day, and there's only a global supply of 1 million ounces available, that would mean that those physical ounces were traded 1,000 times a day. But it gets even crazier than that, as there is only 30 million ounces of silver in the COMEX available to trade. On average, if 3% of the people that traded silver on the COMEX actually took delivery of their metals, there would be no silver available.
We went and looked at the COMEX. So the COMEX at the time had about $80 billion of open interest between futures and futures options. And in the warehouse, they had 2.7 billion of deliverables. So 80 billion of open interest, 2.7 billion of deliverables. We're going to own it a long time. You're on the board. You're a fiduciary. What do you do? Like, that's an easy one. You go get it. All right. So you go take 1 billion of the 2.7 billion and let them worry about the rest. Mm-hmm. And when I talked to the head of deliveries for COMEX and IMEX, I said, well, what if like 4% of the people want delivery? And he says, oh, Kyle, that never happens. We rarely ever get a 1% delivery. So, and I said, well, what if it does happen? And he says, well, price will solve everything. I said, thanks, give me the gold.
Fearing that silver would break through 50, they had to put a stop to it. May 1st, the attack came, early morning hours of Sunday night to Monday morning. While most markets were closed, they smashed the price of silver $6 in 15 minutes. This was also the same night that they finally announced Osama bin Laden was dead. Then add on top of it 5 margin increases in 8 days as the market was under attack. I'm sure the paper market manipulators laughed at how easy it all was. For those of you that don't know, margin increases forced long holders of physical silver contracts to come up with more money to hold on to their positions as those positions are under attack. Because most traders have stop losses, the banks can blow through those very quickly as they see both sides of the trades. But once those stop losses are triggered, those that were once long then join the sellers in a waterfall event. Margin increases act as further incentive to get the more stubborn long holders to sell their positions into the market. All of these tricks only serve to move the market one way and for a very limited amount of time, and it has a depreciating effect on the market. No one in their right mind who owned a large stash of silver would sell in such a way that would only serve to hurt the value of that which they are selling. This not-for-profit selling that we saw on May 1st is pure manipulation to suppress the price of silver and give support to the dollar and their paradigm. While all the paper manipulation jostles the market, the physical demand of silver continues to skyrocket. The United States Mint sales of silver eagles continue to surge, and there have been single months in this past year that have sold more silver than a couple years of the 1990s. It is now projected that this single coin would use up all the production of silver in the United States. Another way to look at it is, even though gold is 50 times more expensive than silver, equal amounts of dollars are being spent at the U.S. Mint, Sprott Silver and Gold Trusts, and Gold Money's accounts, meaning that there's 50 times more physical ounces of silver being sold than gold. It is impossible for a market to remain at a 1 to 50 gold to silver ratio when there's equal amount of dollars chasing after both metals. And regardless if silver is going up 400% or knocked down 40%, the inventories at the COMEX continue to drop at a 45-degree angle until the end of October 2011. So what happened here? Well, MF Global went bust. John Corzine, the former Goldman Sachs co-CEO with Hank Paulson, joined MF Global in March of 2010 after losing his governor's seat in New Jersey. October 25, 2011, MF Global said that they had lost big on bets on European bond derivatives. MF Global then did something very illegal and used all of its clients' money that they had sitting in segregated accounts to pay for their losses on these European derivative bets. Some 60,000 clients that were invested in commodities through MF Global, like Gerald Celente, had their accounts wiped out. And if that's not bad enough, the CME, the market in which MF Global, the broker, was participating in, did not protect the clients and refused to cover their losses. This is unheard of. And I believe the reason why the CME did not cover MF Global's clients is because that there's other brokers out there making these big derivative bets. And if the precedent is set, the whole market could go bankrupt. With the MF Global customers' accounts frozen, The market continued to trade, and worse, they were asked to put up more money to hold on to their positions. No one in their right mind would put up more money, having their money just stolen. Since they were not able to meet the margin requirements, their positions were closed out. I believe that MF Global was actually a direct hit on the commodities market, as a delivery month was coming up and investors that were still up could have taken delivery. This illegal action does not seem to be a big deal to the regulators, as they let John Corzine dance in front of them.
I simply do not know where the money is. Congressman, I don't recall, and I don't recall.
Again, all these manipulations can kick the can down the road a little bit more, but they cannot stop reality from coming. I know of about 60,000 clients that will no longer trust a paper casino again. And if they do get their money back, they would be wise to buy real metal instead of playing in their rigged game. So with MF Global bust and 60,000 clients out of the game, this is the time that the silver downward trend breaks, as millions of ounces suddenly pour into the vaults of the COMEX. And if you look at the inventories over the last few days, it seems like the silver is flooding out of the vaults again, as people are wise to take physical possession of their metal. I see more money thrown at this market, I see more short positions, more criminality to hold this market back, and the returns and the time that they get are getting smaller and smaller. The window is closing on them, and they feel the heat coming.